Good morning, I'm Tim Wood, Chief Executive of McEnroy & Wood, and with me today I've got Guido Bicocchi, our Director of Investment, and we're going to talk about some of the major investment themes that are affecting client portfolios and how we're actually positioning portfolios to take account of those. Looking back to November when we published our last occasional article, we were talking in some of the themes about the possibility of not only a higher level of inflation than is currently expected, but also one that is more prolonged. How are we positioning client portfolios to account for those views?
You're absolutely right, Tim, that inflation has been hitting the headlines recently and is at a rate that's higher than it's been in over 30 years. And we've been concerned for some time about that and positioned the portfolios accordingly. So I think, firstly, there are a number of short-term factors that are influencing inflation at the moment, things like the supply chains around the world getting clogged up, and they're likely to dissipate over the coming months. But they may well be replaced by other factors. For example, wage costs in many industries in the UK are going to be affected by the national living wage going up by more than almost 7% in April of this year. And at the same time, the construction industry are no longer going to be able to use red diesel, which will again add to their cost base significantly. Over the medium term, we're concerned about things like companies bringing manufacturing back onshore, closer to home, in order to protect their supply chains and moving that away from cheaper destinations, places like China, for example. And the cost to extract crude oil is going to go up. And again, that's a major input cost for many industries around the world.
So if we actually now look to what we're doing in client portfolios, perhaps you could just say briefly how we're managing those risks within the portfolios.
Absolutely. So within the equity parts of the portfolios we manage, we look for companies that are able to pass on costs, protect their pricing power effectively. So for example, we've got an investment in XP Power, which makes power packs which are critical to the operation of machines in factories and hospitals around the world. And the cost of that power pack is actually insignificant when compared to the overall cost of the machine. And that allows them to pass on any price rises to their customers. Within the bond element of our portfolios, we've got investments in the index-linked bonds, which are linked to inflation so that both the capital and the interest that they pay is protected. And within those portfolios where we hold gold, that's proven to be a store of value historically, particularly in times of uncertainty, for example, when we see spikes in inflation.
And it's all too easy to become very gloomy and say all asset prices are incredibly inflated at the moment, which they are by most historic norms. But what are the prospects for growth today?
Well, we're actually quite optimistic about the medium to long-term prospects for growth. The pandemic that we went through, it wasn't very nice, but what it did do was actually accelerate some of the trends and the investment themes that we've been interested in for some time. So, for example, in healthcare, people are living longer and people are growing older. And as a result, we'll need things like healthcare. They'll need to wear glasses, they'll need hearing aids, they're likely to need heart surgery or need new joints. And these are all things that we can invest in. So we invest in, for example, a company called Edwards Life Sciences, which provides catheters for heart surgery. So those types of businesses will benefit from those long-term themes.
There is always the chance that we might be wrong about our views on inflation, and in fact it could be that the world fell into a global recession. We're not expecting that at this point in time, but what defence is there in portfolios should that scenario arise?
Well, firstly, within the asset allocation, we've got the insurance part of our portfolios where we hold bonds and we hold gold. Well, if we look back to what happened in March 2020, when investors are worried about the prospects for companies, they look to sell their shares and they look for a safer place to put their money. And that safer place tends to be government bonds and gold, where there's significant uncertainty. So we've got significant allocations to US government bonds in our portfolios and gilts in our portfolios. And those will help to protect portfolios from the worst of the falls when we do experience a rough time.
And of course, in difficult times, the US dollar itself, it tends to be strong because people usually flock to the dollar if the world is having a very material adjustment in economic terms. And the dollar tends to be a place where people like to put their money as a safe haven as well.
Yes, absolutely, absolutely.
One of the benefits we feel of our direct investment approach around the world is that ultimately we can adjust portfolios to accommodate all investors' needs. And that's even more relevant today when it comes to ESG investment, where people want more and more restrictions on the portfolios and on us as to what we might invest on our clients' behalf. Could you just very briefly summarize the benefits of direct investment in that regard?
Absolutely. It means we can be selective about where we want to invest, and we can tailor a portfolio to a client's needs. ESG has been again in the headlines over recent years, but it's been something that we've been thinking about and including in our investment process for decades. And it comes back to stewardship. Because we invest directly in companies around the world, we engage with those management teams of those companies, and that lets us understand what they're thinking and how they're managing their own businesses, and that allows us to ensure that the way they do things is in accordance with how we would like things to be done in our clients also.
Well, Guido, thank you for your views today, and as always we continue to assess our own views in relation to the global economy and indeed where we see the opportunities arising. And we'll have further conversations, no doubt, in the coming months about how our views might be changing over time. So thank you.